Yeah, I've had clients that just are determined to take it as soon as they can.
Absolutely.
Because they just want money before the government shuts down or whatever, before it ends. So
Well,
they're
too
going to
late.
take it. Yeah, exactly.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. The advisors discuss some of our firm's investment processes. These are just a few of the many possible approaches to investing. Individual results may vary depending on your goals, risk tolerance, market conditions, and other personal factors. Please consult a qualified financial professional before implementing any investment strategy.
Welcome to the Market Moment. This is Matt here with Isaac.
Hello.
And John.
Morning.
And today we have a riveting topic to start with. We're going to talk about Social Security and then get into a little bit of market information with where the market's at and some historical context. So it should be a good conversation. Woke up this morning and it was quite chilly outside, so that was a little shock to the system.
Nice, though.
Yeah.
Fall
Oh,
is
big
here.
fan.
It's nice.
Yeah.
We're all in little sweaters. We look so cute on the set here. It was so nice to wake up to that cool
That's
air.
what I did this morning. I woke up and I was like, where's my little sweater? Yeah, no, it's an awesome time of year.
Yeah.
Okay. It's a hard transition to make from that to Social Security. But
And before you start, if you're driving and you're listening to this, pull over. We don't want you falling asleep at the wheel. Go ahead.
yeah, so one of the questions, so we've been doing these commonly asked questions to start the show. And one of the questions we get a lot from retirees or near retirees is, how is Social Security calculated and how big of an impact is it going to make if I work an extra year or if I don't, So going to get into how Social Security is calculated. Like, what is the actual calculation? What goes into that? It's actually kind of complicated, but you can make it really easy for yourself. So here's a plug for a government website, which is kind of weird to do. But if you go to SSA.gov, highly recommend you do this. If you haven't done it before, go to SSA.gov and create an account. You can log in, and some people still get the paper statements. A lot of people are used to getting those. This is the exact same information, but it's a resource that you can go log into and access that information at any point in time in real time. So recommend you go to SSA.gov and create an account if you're looking at what Social Security might be for you based on your real earnings history. So real quick, well, I don't know how quick it'll be, but let's jump into how is Social Security calculated. So Social Security is calculated by first determining your average indexed monthly earnings. Okay, so your AIME is the Social Security Administration takes 35 years with your highest indexed earnings. If you have fewer than 35 years, the missing years are calculated as a zero. So you add up your highest 35 years of indexed earnings. You divide by 420, which is 35 years times 12 months, and that gives you your AIME. Okay. Then you calculate your primary insurance amount. So the PIA, so you have your AIME, and then you have your PIA.
This is making so much sense.
Yeah, I know.
Yeah.
We can throw a link in here to help kind of walk you through this. But the PIA is calculated using a progressive formula with 3 bend points that are adjusted annually. So the formula for 2025 is 90% of your AIME up to 1226. So remember, your AIME, your average index monthly earnings, is your 35-year highest earning years indexed for inflation divided by 420. So you take 90% of that up to 1226. Then you take 32% of the portion of your AIME between $1,226 and $7,391, and you add that to the first amount. And then you take 15% of the portion of your AIME above $7,391.
Yeah.
Got it?
That is
So also,
amazing.
if you go to SSA.gov and make an account, it'll do that for you.
Yeah. That's
So
why
there's two ways to calculate it.
ICYM, is that in case you missed that. You go to,
And that's why I started with that.
Yeah,
Like,
no,
a
I'm glad we
way
got that
easier
out of the way. Yeah.
Yeah.
great.
So, but if you're just wondering what the calculation looks like behind, like what's going into these numbers, are they just pulling them out of thin air? The answer is yes, they absolutely are. But no, there's actual numbers and calculations based on your real earnings history. You figure out your index monthly earnings average, and then you have to calculate. There's like a progressive, think of it like your progressive tax brackets, like a certain amount up to this is taxed at this, and then you add on top of that. That's kind of what they're doing here. And so you take 90% up to 1226, and then 32 above that, and then 15% above 7391. And that gives you your full retirement age benefit. So for most people, that's age 67 these days, if you're not already retired. So that will be your age 67 benefit for most people. But if you retire at a different age, then there's additional adjustments you have to make,
Sure.
right? So if you start Social Security, not just if you retire, but if you start Social Security at an age earlier, younger than 67, then you're going to get a reduced benefit. And if you delay it, defer it to age 68, 69, or 70, then you get an increased benefit. So
And we've talked about that a lot on this show because it's a common question that pops up, right? Like, when do I take it, or what's my benefit?
Yeah.
I think we did a whole show about when to start it.
Yeah.
And just to reiterate, if somebody's listening that hasn't listened before, it depends.
Yeah.
Right. And
We have to know when you're going to die.
I know when you're going to die, because
If we know that,
if we know that, I
we
can
can make the calculation.
Absolutely. Because if you go online and you just find like a calculator says when should I turn it on, it's going to tell you 70.
Yeah, because it's
Most of it.
assuming
It's
that you're going to live past 85.
Yeah, it's assuming you're going to live to 90, 95, 100, and it's going to say, well, if that's the case, mathematically,
Yeah.
take it then.
Yeah.
So it's a very personalized decision of, health history, things like that.
Yeah, I've had clients that just are determined to take it as soon as they can.
Absolutely.
Because they just want money before the government shuts down or whatever, before it ends. So
Well,
they're
too
going to
late.
take it. Yeah, exactly. So they're going to take it, and even if they don't need it, which is fine. And then I have clients that wait to the very last second, which is fine. It's all relative. But it's your plan.
You have to
and
just
we
go
determine
into
that
it.
together.
It's like one of those
Yeah.
calculations. You have to go in with kind of some humility and know, like,
Yeah,
there's basically a 0% chance I get this perfully right.
exactly.
Yes.
Right. And
Exactly.
so you don't want to like have analysis paralysis where you just overthink it to
Right.
like use some reasonable logic, some reasonable assumptions based on your individual situation, work with an advisor, a financial planner, walk you through the calculations of kind of your total situation, and then kind of come up with your best guess on when it might make sense for you to start, because it's going to be nearly impossible to just get it perfect.
Yeah. Now, there's times that you shouldn't take it. Like if you're working,
Right.
if you work till 67, wait till 67 to take it.
Yeah.
Right. You shouldn't work, make good money, then get taxed on your Social Security. Like that doesn't make any sense. So there's certain things that we can help you make sense of. But to your point, it's
I've had those conversations with people that they're still working. They want to turn it on and pocket what's bringing in. But if you have earned income, not only do they tax it, they reduce your benefit. And so you're locking in a lower benefit that they're going to also reduce.
Right.
And so definitely there's a lot of ways to mess it up.
Yeah.
No, it
I
is,
think
and
so.
it's a one and done. I mean, it's like you can't go back and reverse something. So a couple key takeaways. If you see these acronyms and things when you're looking at it, AIME, average index monthly earnings. So that's your 35 highest earning years indexed, and divided by 420. And then the PIA, which is your primary insurance amount. So that is your full retirement age, again, age 67 for a lot of people out there listening. That is your PIA, which is, they've taken the average index monthly earnings and applied the kind of percent payouts at the different thresholds and have come up with that calculation. So now, if you know nothing else or learn nothing else, you at least know what some of those terms and acronyms mean. So
I do encourage people to go to that site though if they have questions, because we can't answer. We can't know exactly what somebody's Social Security benefit's going to be at.
Right.
We can make projections or whatever, but it's really not solid. Go to that site and you get an actual number.
Get your number.
Yeah.
for sure. Okay. So moving on from Social Security. So there was this chart that I came across. Well, we have a system that we generates a lot of charts and data for us and research, and so this chart came out the other day, and it was just kind of referencing historical context for where we're at and other periods that people are using to kind of compare where they feel like we're at in terms of the market cycle. And it was I think interesting, different way to look at it. Yeah. So I myself have said, hey, I think a good example of kind of what the market's going through is like the .com bubble, just because it's
AI is
technology,
the new trend.
It's technology driven. AI is kind of the internet and what the internet was in the late 90s. And who knows where we're at in that cycle and how much truth is and how much is really similar or different compared to that period of time. But I thought this chart was interesting. So if you look at like the 4 biggest stocks now, the 4 blue chip stocks, and the forward PE ratios relative to the late 90s, the tech bubble, this was in March of 2000. So this was kind of the .com
as it started,
peak.
Yep.
Versus today. So back then in early 2000, you had Intel, Microsoft, Oracle, and Cisco. It's interesting. Microsoft is the only name that's in both. But and then today you have Google, NVIDIA, Apple, and Microsoft.
Yeah.
Back then, the forward PE ratios were 47 for Intel, 60 for Microsoft, 120 for Oracle, and 130 for Cisco. Right? So crazy high forward PE ratios. Today, Google's at 24, NVIDIA's at 31, Apple's at 32, and Microsoft's at 32.
So put it in perspective, the average S&P 500 PE ratio historically since the beginning of time is around 16. That is every stock, so value stock. So when you have a tech stock or a biopharmaceutical stock or whatever that's looking for forward things always, they're going to have a higher P ratio than average, right? Your very deep value dividend paying stocks are usually going to be lower than 16, and you're in a healthy market, and your tech stocks will be higher. So those PE ratios are not out of whack at all. In fact, they're pretty healthy.
Yeah.
For the great companies.
Yeah. So it's kind of a good reminder for all of us, myself included, where it's like, man, this is a pricier market, and there's some truth to that when you look at kind of the total market. But when you start looking at some of the names that have been driving the market, it's like these things aren't out of whack. No.
And if you look, like I could go back to the 2000 time, and I could tell you, like the companies, the problem with the .com burst was it was a lot of startup companies that had no revenue. Now these companies that are leading this market have obviously massive revenue. The AI boom is from the big boys, right? Yeah. The big companies that have obvious revenue, and some of these companies like Apple's had cash on hand forever. They're not in any trouble, debt problems, or anything like that. It's a much stronger market in relation to the .com bubble, which you had all speculation. Yeah, AI is some speculation of where it's going, how much it's going to actually impact the economy, and you can have arguments of is it better or worse for jobs and so on. But the stocks themselves are, like you just said,
not crazy.
No, they're not crazy. They look pretty good.
Yeah.
No, I would agree. I think whenever you start talking about PE ratio, price over earnings, there's 2 things that can change to adjust it: the price of the stock or the earnings. And as long as they're both going up, you're staying in like kind of the similar area. And earnings have kept up, right? These big companies are shoveling money into these smaller AI companies. Like, I mean, I'm going to make up a number, but like Meta's spending $100 trillion on AI or whatever, and that's getting sprinkled into the market over a bunch of different companies and making the PE ratios reasonable.
Yeah, and it's not just these great companies.
It's not 100 trillion compliance.
It's not just these great companies that are doing well. All of the companies that work for them, under them. I mean, you can go into all different types of areas that are being affected positively. It's kind of a cool, different thing. I will say, since 2020, the COVID outbreak, to now, and I've been doing this for quite a while, this is the hardest market for me to get my hands around. It's a hard market for me to understand because there are things that are shocking to me. I'll give you an example. When I first started in the industry, I was told, this is from somebody teaching me, that always look at this sounds weird, but the ISM data, the manufacturing index, the sentiment index. If it drops below 50, it shows a contracting economy. Be careful, be aware, da da da. And of course, we've been below 50 for several, like a year now on the ISM data, and the market just keeps roaring. So like simple things like that, which used to work fairly well, and you could kind of tell the market movement, they're not relevant anymore. It's weird
they
how
just
we've...
mean,
they're
if
relevant. They've been relevant
they
again
don't mean
someday.
what they used to.
No, they don't.
Right? And so, and to Isaac's point, with PE ratio, right? So for everyone out there, you probably know this, but just to kind of take a step back, right? The PE ratio is the price per share divided by the earnings per share. And so, anytime you see a major move in the PE ratio for a company, a couple of different things are happening. Either you have earnings like cratering and the price hasn't moved much, right? So the PE ratio is trending higher.
Yeah.
Or, earnings aren't keeping up with and you're getting like multiple expansion. So the price is just climbing, but earnings aren't following, right? And so that's what you see like in the .com years where the share prices were just continually climbing.
Yeah.
And the earnings weren't
there.
following.
Yeah.
Right? Where the last couple of years we've seen prices continue to trend higher, but the earnings have followed. And so it's kept that ratio in line. And so, you'd have to have a major crash in earnings to really impact
We're in earnings
that.
season right now.
Yeah, and earnings, like
positive.
I was saying, like Coca-Cola, GM, like everyone who keeps announcing, like earnings have been strong.
Yeah.
And so,
it's not just tech stocks. It's broadening out where other firms are starting to, and which is really, this is when it's all going to turn around because I'm the pessimist on here, but it's like a really healthy looking situation right now. And I have not felt that way in a long time, which is why, we got to be careful.
You could always have earnings come down for sure.
Yeah.
But that is less likely or less scary, I guess, versus just having a P ratio that's extended because the price of the share, because the multiple is just crazy out of whack, because that can very quickly and easily be adjusted.
100%.
Right? And so we're just, based on historical data, we're just not there right now.
The market, I always said this, the market, we like to think it politics matter. We like to think that all these things matter, and they do, right? Everything matters.
In the short term.
Things matter. But it really comes back to corporate profits.
Is it?
Right? If corporates are making profits, the market will continue to move in that direction, right? And it really is as simple as that, right?
Yeah.
So you watch these earnings statements. I look forward forward. What are they saying about next year? What are they saying about their next? Yes, they've done well last quarter, but I'm listening more intently to their projection, and you want to hear they feel like things are going to continue to go, and they're going to keep making all their analyst marks. What you don't want to hear is, we hit this quarter, but we see a reduction in orders or whatever. That's when I would start getting nervous about this thing capping out, right? But we really haven't seen that yet.
And even in there, you're not, again, who knows? But you're not talking about like anything could happen. But like you're not talking about like a crash kind of scenario. You're just talking about continued growth forward, or projections start to flatten out or trend down. It's not like, hey, we've gotten way out over our skis, and all of this is going to get repriced in a very short period of time, which is what kind of the definition of a bubble is. So, I think there's a lot of things there's always risks in the market, no matter how good or bad things look. But I think there's a lot of things to be optimistic about right now. As much as easy as it is, human nature, I think we fear and get nervous at all-time highs, naturally. Like you just think, oh, we're at all-time highs, or you see a headline, the S&P hits a new all-time high. You think, oh, that was like a moment in time. Like, should we capture it and wait until?
Yep.
And it's like the market. If you look at history, the market it continues to grind higher, and it's not something that we should fear especially when the fundamentals of the market remain intact.
Now, conversely to that, what is another thing that is weird to me is gold hitting all-time highs.
Yeah.
Right? The flight to safety vehicle that has been there forever, that typically when it's soaring, it's because other things are suffering, and it's soaring while everything else is soaring. And again, it goes back to being a weird market. And the last 5 years has been weird.
And I was listening to a podcast the other day, and they were talking about, and I'm not have no expertise in like gold and precious metals and like what those should or shouldn't be doing. But, with, they were talking about how, most of that has been driven by central banks.
Yeah.
Just gobbling up gold.
Yeah, which is crazy.
This
China,
guy, the guy who was talking about it was saying that he thinks that they're pretty drastically under, representing the actual amount that they have, and that they are buying, and that there's just a lot of gold being bought by central banks, which is at least a portion or part of the major, change in the price of gold that we've seen. So I don't know. There are some weird things, because historically you'd be like, well, gold is doing this, so that means this.
Yeah.
But there are other, variables out there.
Oh, of course.
That
Go back to financial crisis. Before financial crisis, gold was way under 1,000 an ounce, and I can't remember the low it was at, but it was well under 1,000 an ounce. We had the financial crisis. Gold shot up. Right, it went above 1,000 an ounce. So when it went above 1,000 an ounce, it was like, wow, this is pricey. We're above 4,000 now, and the market since the financial crisis, the Dow, again, I'm going back to the Dow, is
made up thing.
I gotta get on the S&P, but the Dow was at 6,400 in March of 2009, and we know it's above 46,000 now.
Yeah.
So I mean, we've just gone so far in that front, but so has gold, and so I mean, it's just Bitcoin is a new twist to the thing. What does that stuff do? And I still don't understand that.
I don't know if you guys pay attention to that at all, but there was like a massive liquidation event.
Oh, there was
$20 billion of leverage getting liquidated.
That's true, but it's
crazy.
still it's still above 110,000.
Oh, I'm just talking about the liquidation event. Like,
no, I know, but it's crazy.
It's crazy that you're able to borrow against that so aggressively. I mean, I talked to a guy the other day. He said his brokerage is letting him borrow 80% of his Bitcoin value.
Yeah. See, that's the stuff.
That's
the
scary
like
stuff.
That's scary. So there are little things out there that are still, I look at the ISM data. It's a little nerve wracking. Now, one thing, good news. Our I thought this was kind of funny. Federal budget last week with the deficit clocking in at 1.775 trillion on a fiscal year 2025, which ended September 30th, was 41 billion smaller than the deficit the prior year. Yeah. Like 41 billion smaller and it's 1.775 trillion. We have a long ways to go, but the government shutdown right now. This is the only thing I want to say about the government shutdown. It's like. So 31st, we talked about this a couple weeks ago, 81st out of the last 30 years. So it's like, it's going to be okay. We're going to get through it all. But here's one trick that we could do to help get this solved. What if the senators and representatives, House Representatives, didn't get paid during a government shutdown?
There was a couple of them that put that proposal, put that forward.
A couple bold ones, which is great, but
shocker, it didn't go anywhere.
Yeah, and they're threatening to not pay our military.
Yeah,
that are protecting our country. I could get on a really rant here.
Sure,
it's just so frustrating. If you put that little thing in there, the next time they have a government shutdown, they are the first ones to not get paid. It would be amazing how fast they'd get stuff done.
Yeah.
Anyway, I'm just frustrated at stuff like that. But there's still little.
We're trying to be optimistic here, John.
I know, but there's always little wolves at the door. You have to be careful.
There's a lot going on.
Yeah, gas is under $3 a gallon.
Yeah,
average.
Excellent.
Which
Drill,
is
baby,
great.
drill.
Yeah, there you go. I wanted to end on a positive note.
Yeah, that's perfect.
Yeah. Well, I think to kind of summarize everything, I think there's always risks. There's things you should be aware of. There's things that you should, you should be diversified. Not be overexposed, because there's always going to be something that comes out of nowhere. It may not be a market-wide event, but it could be something. We saw something last Friday, with the regional banks and some of the credit issues and concerns, and there may be more there. There may not be. What I liked about it was that the market reacted very negative very quickly.
Yeah.
And so, they wasn't that long ago where we were in this weird environment where there was like bad news was good news, good news was bad news.
Nobody
and
cared,
the market was doing weird things when like we had bad news because of COVID. It was just
right.
And it's like just seeing the market, there's like a bad headline and
it naturally reacts.
Unknown risk that came out there, and the market sold off.
Yeah.
Quite a bit. 1.5%, 2%. It's like that's good. Like I like that, because that's how it should be.
Exactly.
I also like the fact that we came back and quickly recovered.
Yeah, we did.
At least the market's reacting kind of rationally.
Yeah.
So
Exactly.
well, that's all we've got for today. We kind of rambled there for a while,
great.
so
it was fun.
Filled up 25 minutes. But Social Security, important decision. Know how it's calculated. Know how that impacts you. What that looks like and means for you. Go on to SSA.gov. Get access so you know what your personal benefits are. We'll post this chart that I showed earlier talking about forward PE ratios today with the big companies versus the .com bubble. Hopefully that'll help you get a good night's sleep tonight. So as always, we appreciate you guys watching and listening. Give us a like, subscribe, comment, shoot us an email, and we'll see you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.